Alright traders, welcome back to my channel. I am Kaya Trades and I am a day trader. So today we're going to talk about candlesticks. Okay, so as you can see, we're on TradingView, we got it pulled up and we see red and green candles. Me personally, I've changed my candles to pink and black, but for this example, we'll go ahead and just use the standard red and green candles. Alrighty, so our red candles mean price is bearish. Price has been going down. So let's go ahead and write that. Alrighty, and then we have the green candles, which are our bullish candles, meaning price is going up. But how can we tell the difference? I mean, if it's really hard to kind of tell, we can just take it off of this candle right here. It just opened, and at the bottom of this candle where it opened, this is where price opened and it started pushing higher. Obviously, there is a thing down here at the bottom of that is called the wick. So the actual color that you see, the big fat candle right there that you see, that is called the body of the candle. However, these tiny little things sticking out of the top and the bottom are called the wicks. The wicks are just where price has gone. The body of the candle is where price opened to where price closed. So right now, price opened at this candle and it's gone this high up. But as you can see, it's still an active candle. There's 4 more minutes left in it. It could potentially close way down here. It could potentially close way down here. It could potentially close way up here, turning the candle green. If it goes back past this level, it'll turn green. As for this red candle, so let me just break it down a little bit better. So let's see. We have this green candle that opened here and it went up and it closed here. So the next candle opened here and it's red because it went down and closed here. So this next candle opened here. It has gone up, but it's going back down. If it closes here, the next candle will open here, so on and so forth. There are different kinds of candles that you can see. As you guys can see, this is the biggest candle on the screen. That is a bullish engulfing candle. It was a bigger, much bigger, probably like 3 or 4 times as big as this candle here. So it's more of an engulfing candle. I have a picture here that I'm going to pull up to help us kind of understand the candlesticks a little bit better. So I'm going to go ahead and pull that up really quick. Alrighty. So we have this candlesticks we just mentioned. Price opened right here, went all the way up. This was the highest that the price came to in this candle. This was the lowest that the price came to in this candle. But price ended up closing right here, causing the opening price to be lower than the closing price, causing it to be a bullish candle. Now, as we recall from earlier, these are our wicks, wick, 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 and these are our bodies. Perfect. I have one more picture to show us that'll kind of help us understand it. And that is this candle here. When I was a beginner trader, I used a journal, and we're just going to zoom in on this just a little bit, see if we can zoom in on it. Alrighty. So as we can see, it is in black, but this would be our green candle that opened here, went higher, closed here, and our red candle that opened here, went down and closed here. This candle engulfed that candle just because it's a little bit bigger than it. We generally like to see that huge engulfing right there, but either way is fine. If you guys would like to be in my Discord with more information, you can go ahead and click the link in the description box for a few more tips. But this was my spiel on just a few candlesticks to kind of get a beginner's basic on what you're looking at. So we have bullish candles coming in, a bearish candle here or there. This is a lot of consolidating. Price is just really staying in one area. But then we see price coming down. There's more red candles than green. Then we see this really bullish candle starting to go up. And then we get another same thing. Price is really just staying in the same spot. So as we can see, and as I mentioned a little bit earlier, consolidating, when price is staying in a general area and hasn't decided if it wants to go higher or lower, we call that consolidation. And consolidation is when price is ranging or staying in the same area. Okay, but as we can see, this part is not ranging. Price is clearly moving upwards. Price is clearly moving upwards. So we can see that this is a bullish trend. A bullish trend. This is the important part with the market structure. Bullish is when market is going up. Let's see if we can find a bearish one. Kind of right here below it, we can see the price moving lower. Price is moving a little bit lower. So it was more of a bearish trend right before market turned around and went a little higher. And this would be our bearish trend, and the market is going down. The important part that you have to learn when you are dealing with market structure is your time frames as well as breaks of structure. So this market was trending down. However, over here, what was it doing? Trending upwards. So overall, we've been bullish, but market had more of a pullback in this one, and then kind of tried to start pushing up higher. And then we got this break of this high, which is a break of structure. So it's consolidation over here. This line right here is breaking above the most previous high. The most previous high was right here. We can delete these. The most previous high was right here, and price broke above that. So that is giving me more confirmation of this bullish trend. Now, when price started going sideways, even here, if I delete this and drag this kind of right here, price has really been in the same spot for a little bit. It's been ranging in between here. It broke out just a little bit, but then it came right back to this level and started consolidating again. You do not want to trade my strategy, which is supply and demand, in a market that is going sideways or consolidating. We only want to take buys or sells in a bullish trend or a bearish trend market. So as you can see, market was going up, it had a pullback, and it came back down. So I would not consider this my actual bearish trend. The overall picture is still bullish. We just had a pullback in the market. So I'm going to make this a different color. Let's say, let's do white. Okay, so when we're moving in a trend, market is never going to move just in one straight line. You'll never see all green candles for like a day. You won't see it. If you do see it, that's I don't even know what you're doing. I don't even think you're trading at this point. But what market does like to do is go up, then down, then up, then down. So let me show you that really quickly. Let's go to our pathway. What market likes to do is go up in a bullish trend, go up, pull back a little bit, go up again, break structure, pull back a little bit, go up again, break structure, pull back again. And this is my bread and butter for my trades, because what I wait for is when market goes up, makes a high, perfect. It comes back, has a pullback. It did not go lower than this low. Okay, so I still have an idea of us being in a bullish trend because we go higher again and we broke structure. We broke the structure right here. So we went a little bit higher. So for my strategy, I like to wait for that number one, break of the structure up to the highs. And then I'm going to mark out a zone that I want price to come back into, tap it on the pullback, and then shoot for another target for highs. So I would enter my position right here, put my stop loss there, put my take profit there, and sure enough, this executed. I'm going to zoom in just a little so you can see. Sure enough, once price broke structure, came back, tapped this zone, which is called a demand zone. We use a demand zone in bullish markets. Hopefully you guys can see that. It's blue. We use a demand zone in bullish markets. Once it tapped my demand zone, I went ahead and entered that position, had my stop loss here, had my take profit here, and what did price do? Shot all the way up to my take profit. So conversely, we have the bearish trend. So let's get our fancy path tool. Price made a low. Price came back and did a, I wouldn't call it a pullback, but more of a retracement as well to fill in. Then we broke structure down to the downside. Price went back up to tap a zone and then back down again. That's a wonky looking bearish trend, but that's okay. So we had the break of structure yet again. So it created a low. Market broke past that low, creating a new low. Then I'm going to go ahead and get out my square tool or rectangle tool, whatever you want to call it. Create my, now what was a demand zone for bullish markets is called a supply zone for our bearish markets. All right. So now I'm waiting for price to come back and tap this zone before I enter and then move my stop loss down, move my take profit down to the low there. So we're going to grab the opposite. So the long position was for buys. I'm going to go ahead and go to my fancy tool for the short position, put it at the start of my supply zone, and then move my stop loss, move my take profit. Lord have mercy, can't speak. So I've got my stop loss above the zone and my take profit at the next low, most previous low. And what happened? Price went down and smashed it. So this is my supply and demand bread and butter. But I do not draw my demand zone or my supply zone if I do not get a break of structure. So we're going to delete this really quick. And we're going to rewrite this. If price is moving downwards and I do not see a continuation of a break to the lower side, to the downside, price is going down, but this next leg down does not break the low, but instead comes higher and then doesn't break the low again and comes back higher and doesn't break the low again and comes back higher. What are we now transitioning from? We started off in a bearish trend, but we did not break this low. But where did we get that break? We got that break right here. And even if I don't even feel like I want to draw this one, we had it again. So if I miss drawing out this square, if I miss drawing this zone out, there's another zone that just presented once we broke structure here. We broke structure here, another zone presented. Now I'm going to place my long position right here at this level, right here under this box, shooting for the high. Price tapped that zone, pushed up to the highs. Okay? So we're going to do it one more time on a bullish example. But I'm not going to draw the full chart. I'm going to wait to draw my demand zone. Okay, let's go to my path one more time. So if I'm here and I'm going up and I come back down and I do not make another low, but I do in fact break this high. Where did my break of structure happen? It did not happen down here, but it happened right here. So I'm just reacting to what the market is giving me. I could have drawn this line there. I could have drawn this line here just to kind of see it for myself and confirm, okay, we did not go past this low, but we did break above this high. So now I have full confidence to draw out my demand zone. So then next up, all I'm waiting for is for price to come back down from this high, come back down, tap me in, and then shoot higher. To which once it taps into my demand zone, I'm going to place my 1-to-1 ratio, but typically for me, even in this example, it's perfect. I do my 1-to-2 ratio, which is very close to these highs. Price obviously right here, tapped into that demand zone and shot up to the high. So really quickly, just to summarize it, demand zone is for a bullish trend market, bullish trending market. And a supply zone is for a bearish trending market. Alrighty, I hope this helps. If you didn't quite get it the first time, go ahead and rewatch it. Watch it as many times as you need until it finally clicks. Write it down, journal it, view it, draw it out. Get your mind used to market structure, because market structure is the bread and butter of any trading strategy, especially mine for supply and demand, but it works for every strategy. Knowing structure will help you understand how to react to the markets, because you don't want to guess. Is it going up? Is it going down? You don't know for certain. No one knows for certain, but you want to react to what you're seeing as opposed to making a guess. Like, maybe it'll come back down. Maybe I'll place my stop. Maybe I'll place a short so it'll come down here when I clearly see it did not break a low, giving me the indication that it's going lower. It broke above, giving me an indication that it might go higher. So I took a chance on this trade. I was willing to risk money to make money, and I could have very well lost it. The price very well could have came down here and I would have taken an L on this trade, and that's perfectly fine. L's are a part of the game. You have to learn how to be a good loser so that you can learn, okay, why did this not work out? But because what happened? Where did we break? We broke below the lows, and that's okay, because my 2-to-1 is going to outweigh my one loss any day. Excuse me. But all right, hope this helps. If you have any questions, go ahead and leave a comment below.